Bitcoin has now broken below the previous cycle's all-time high, an event many crypto holders thought impossible at this point of the cycle. For 9 straight days, Bitcoin's price has been pushed lower through consistent methodical sell pressure. Not emotional capitulation, not retail euphoria flipping to fear. Just steady distribution, day after day, as bids thin out and confidence erodes. At the same time, nearly $5 trillion has been wiped out across global markets in just the last 36 hours. Equities, commodities, crypto, all moving together, and notably, without one clear headline you can point to as the cause. That's important, because when markets fall without a clean catalyst, it usually isn't about one event, it's about the stress already embedded in the system finally being exposed. In crypto specifically, the damage has been severe. Over the last day alone, more than $2 billion in leveraged positions were forcibly liquidated. Bitcoin dropped below 64,000, erasing over $200 billion in market value. Ethereum broke below key levels of its own, and across the board, altcoins have seen sharp, disorderly drawdowns. But the real question isn't simply why Bitcoin is down. The more important question is what this phase represents and what lies ahead. Is this forced selling finally reaching exhaustion? Is this a broader deleveraging event that still has further to run? Or is this the kind of moment where markets quietly transfer risk from weak hands to strong ones, without the drama people expect? In this video, we will bring you expert analysis from Raoul, PlanB, Charles Hoskinson, and others to deeply examine what's behind this crash and where crypto goes from here. If you value deep dives like this, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Historically, these bear markets drop to, if you look at, for example, 22, they drop to the moving average, realized price levels. And here too, you see the blue RSI, the bottom of the bear at the 200-week moving average, the black line, and same in 2015. So that could be right now at the 50, 60,000 level. Very well possible. Or if you take the worst case, it could drop 80% from an all-time high. That happened before. It could happen today. The all-time high was 126,000. So 80% drop would be 25,000. That would be somewhere here between these two lines.
After months of denying the obvious, like many crypto investors, PlanB has decided to accept the cold, hard truth. Bitcoin is in a bear market, and prices might fall even faster and lower in the coming months. Bitcoin bear markets don't tend to end because sentiment feels better, or because a narrative flips. They usually end when price compresses back toward long-term value zones, areas where leverage has already been flushed out, and sellers simply run out of inventory. Historically, that process has meant price drifting down toward the 200-week moving average, and in deeper bear markets, toward realized price, the average cost basis of all coins on the network. Those levels have consistently marked zones where forced sellers finish and long-term participants begin stepping in. What's important is that this doesn't require panic. In fact, some of Bitcoin's deepest bear markets, including 2015 and 2018, unfolded through slow, grinding declines, not dramatic collapses. Price bled lower for months while confidence quietly eroded.
Bitcoin right now is already down like 17% this week, you know? You could argue in the context of a bear market, we're like in this zone, maybe like right here, or something like right here. So I think what's likely going to happen is that we're going to come into some like type of major capitulation low. And when we get a bounce, that might then be a low that holds for a while. So I want to give you a couple examples, right? So in 2022, when we finally came down, so you can see we eventually broke down below these lows. And then a couple of weeks later, right? A couple of weeks later, Bitcoin then set a low, and then that low held for a few months, right? And essentially what happened is Bitcoin went sideways until the bull market support band, or I really should say until the bear market resistance band came down, and then it got rejected again. So you could see something like that happening again where, Bitcoin drops, and and then perhaps it just kind of goes back. It just waits until the bear market resistance band gets down here, and then it drops again. Could definitely see it playing out like that. We are coming up on our date with destiny. I hope you guys are ready for the date, because Bitcoin's already almost there. The 200-week moving average is now at 50. What is it at? 58,000. So, I'm not saying that's going to be the bottom. I hope it provides some relief for a little while. You can see that last cycle, it provided no relief. We just went straight through it. So I'm not here to suggest that it has to be anything. I just know that in bear markets, Bitcoin goes to the 200-week moving average, right? And, I don't control it. You don't control it. There's not a single one of us that can change it, right? Like, it's going to happen it's almost surely going to happen eventually, no matter what, right? Because it always does. And there doesn't have to be a rhyme or reason to it. It's just what happens in Bitcoin bear markets, that it eventually goes to that 200-week moving average. And last cycle, it actually went below it. So, it probably will happen. What's remarkable is how much faster it's happening this time, because normally it takes a longer time to get there. But since we had our weekly close below the 50-week moving average, it's only been 12 weeks, and we're not that far away from it. If you look at last cycle, after getting our first weekly close below the 50-week moving average, it took Bitcoin about 26 weeks. So if we were assuming it'd be the same amount of time, instead of happening really soon, it would be happening out in May. Now, I think the most likely month for a bottom is October. But if you made me guess another month, if you told me that, hey, Ben, the low is not October, guess again, then I would probably guess May, right? So I think those are the two most likely months, May or October. And if you look at last cycle, Bitcoin actually fell into June. And no one really knows, right? No one really knows. But the sort of the rationale for October is pretty simple, right? It's just looking at the prior bear markets, also just looking at these two. This was December to December. This one was November to November. Perhaps this is just simply October to October. Furthermore, if you look at the ROI from the low for Bitcoin, ROI after the cycle bottom, and then you extend that out to the next low, you'll see that Bitcoin topped when it always does. It entered into a bear market when it always does, and then it's just been moving down ever since. Now, what's really interesting is if you look at the year-to-date ROI of Bitcoin in 2026, if you compare that to, say, 2014, you can see that in 2014, Bitcoin also had a similar drop, right? It had, from the yearly open, Bitcoin dropped about 30%, and then it had a nice little rally up, and then it came down. So it's going to be a difficult year. Make no mistake about it. Whenever there's a rally, it's going to be hard, because the temptation to assume that the next bull market has started is going to be very high for a lot of people. But I do think it will result in a macro lower high whenever it happens. Now, if you look at 2018, you can see that Bitcoin also sort of moved up early in the year, and then it had a capitulation into early February, and then it came out of that capitulation and basically bounced back up, but then it eventually just came back down. So what I could see happening is whatever low is formed in the coming days, weeks, it might end up being a low that lasts for a while.
What Ben is describing here is how Bitcoin bear markets actually resolve, not with one dramatic bottom, but through phases. What's different this time is speed. We're approaching those lower levels far faster than in prior cycles, which suggests stress is being pulled forward rather than spread out. That doesn't tell us where the bottom is, but it does tell us this is not a normal correction. This is a market compressing risk quickly, and that tends to produce choppy, psychologically difficult price action, even after a local low forms. After laying out how deep bear markets can go, and how long they can linger, it's worth addressing something charts don't capture particularly well: what this feels like while you're inside it. For this, we turn to Raoul Pal's latest analysis on the Bitcoin and crypto crash. Pal doesn't start with charts, probabilities, or cycles. He starts with the part markets rarely model, the psychological state you're in when things feel broken. It feels brutal out there. There is no hope. It is over. You missed it. You f***ed it up again. Everyone is angry, confused. These feel like the worst of times. I've been in markets for 38 years now, and I've seen every type of crash and panic. They all feel the same. Awful. The key insight is subtle but critical. Every drawdown feels unprecedented while you're inside it, even though emotionally they're almost indistinguishable in hindsight. That emotional sameness is what makes people abandon strategies they knew were correct just months earlier. Pal continues by writing, "In a secular rising asset, the key is just to do nothing. HODL is a meme for a very good reason. Adding aggressively in the sell-offs massively compounds returns over time, even more so than DCA. It always feels like you've missed your chance. It's all going to blow up forever. It is not the case. This isn't about comfort, it's about math. Drawdowns don't invalidate long-term theses. They test whether your position size and mindset are survivable. Adding into weakness lowers your future cost basis and raises your margin of error if you're sized correctly. The pain you're feeling isn't a signal that you're wrong. It's the cost of being exposed to volatility significant enough to matter." Pal ends with some suggestions on how to survive moments like this. Don't rent the conviction of others. Earn your conviction. Renting conviction is like leverage. It'll blow you up. Yes, it feels dark out there. Soon the sun will come out again, and this will just be another scar in the journey. When will this all pass? I don't know, but I think this is more like April to November 2021, a panic in bull market. I think it ends very soon, and if I'm wrong, I won't do anything different. I'll just keep adding when I have some cash. Good luck out there. It's never easy. Volatility is the price we pay for assets that compound these kinds of returns over time. Embrace it. Next, we move to Charles Hoskinson as he takes us through what these moments are really about.
The markets are tough right now. It's red. It's red, red, red. It's almost like The Shining. Red room, red room. And people are not feeling good. But you have two choices. You can either turtle up and you can just say, hey, it's over. Everything's coming to an end. It's all collapsing. It was all a scam. Everything we tried didn't mean anything. Or you can say this is just one of many challenges on a difficult road to freedom. Why would it be easy? Why would any of this be easy? Why would any of this involve a straight path? We're literally restructuring and rebuilding the entire world financial system and everything that goes along with that. Do you think it's an honest system? Do you think it's a fraud-free system? Do you think it's not a corrupt system? It's a reflection of humanity, warts and all. You have good sides and you have bad sides. And nothing is stable right now. Not our president, the United States, not the US dollar, not any foreign policy, not the markets of any asset, whether it be gold or silver, not real estate, because we're going through a transition as a society. Globalism has finally reached its peak, accelerated by AI and accelerated by demographic changes. And the human race is starting to think in terms of we instead of nation by nation. You have customers in every country. You have movements in every country. You speak every language. It's a different way of doing things. And the old guard and the old way of doing things is fading. And they're kicking and screaming as they're being dragged off the stage. And a new way of doing things is coming. The only way to run a world like this is through a cryptocurrency. Full stop. Otherwise, you have to build an empire. And no one's strong enough to conquer the world right now. Not even China. So that's the only option. And as if we're going to globalize, we're going to be one market. We're going to be one group of people trading with each other. We need an economic franca. And you tell me how we're going to do that without a blockchain. Thought about it for 15 plus years. And you know what? I've reached the conclusion there's no other way. So there's an inevitability of victory. We just have to earn it. So the next few weeks and months are going to be hard ones for everybody. There are going to be more red days. And you have every right, if you want, to lose the faith and go home. All I ask is ask yourself, what are you going home to? What are you going home to? A rigged system that robs you 5 to 10% of your wealth, that's going to lay you off when AI takes over? What's the point? We're at the end game, people. Humanity's done with the way things are going.
Charles Hoskinson's main argument is that volatility isn't a bug in the system right now. It's a signal that legacy institutions, incentives, and power structures no longer command the confidence they once did. And when accountability erodes at the top, People don't just lose money. They lose belief that the system is acting in their interest at all. The uncomfortable question he leaves us with isn't whether crypto succeeds or fails in price terms. It's this: if the current system is already unstable, already extracting value, already automating people out of relevance, what exactly are we defending by walking away from the alternative? And if change is inevitable, is opting out really the safer choice? Markets like this don't reward certainty. They reward patience, clear thinking, and the willingness to sit with discomfort without abandoning first principles. If you value analysis that doesn't chase hype, that tries to understand what's breaking before guessing what comes next, consider subscribing. And if you're still here, let me know in the comments what you're watching most closely right now: price, liquidity, or something deeper than charts. Thanks for watching.